See if it works. Great. All right, we're going to go ahead and start the meeting. I believe I'm recording right now. This is Charles. I'm president of Lodge Carmel, Hebrew Order of David here in Atlanta. I know we have a number of guests with us from other lodges. We have lodges in Houston and Dallas with us. Is there anyone else from any other lodges besides Atlanta, Dallas, and Houston with us? Okay, I think we have several lodges with Atlanta and Texas. Let's go ahead and start. Looks like we have a fair amount of people here. We have 44 people so far, and I expect a few more to join us in the next few minutes. So rather than having our normal lodge meeting that we do monthly on Thursday nights, we're going to go ahead and just start our meeting directly with our guest speaker and forego the formalities and the formal dress for this meeting. I'd like to introduce Princeton Williams. Princeton is with us. He is with the Federal Reserve Bank in Atlanta. He joined the bank in 2018 here in Atlanta. However, he was with the Dallas branch of the Federal Reserve since 2006, prior to coming to Atlanta. And Princeton earned his BA, bachelor's from SMU in Texas, and also a teaching certification and a master's degree in economics from the University of Texas in Arlington. And Princeton is one of the leaders of the outreach team for the Federal Reserve, and I anticipate he'll share some interesting knowledge tonight with us. So Princeton, the microphone is yours.
Thanks very much. And I'm going to mute everyone, and then if you need to, feel free to unmute yourself. Question. I'm also going to, and you all should be able to unmute yourself if you need to ask a question. For a few minutes here, I'm admitting that I am fairly new to Zoom. I was telling Charles, we just got permission to use Zoom, and it's easier overall, except I'm tracking who to let in. So I'm going to do my best to multitask, and that's always thin ice. It's certainly an unprecedented time to be talking about the Federal Reserve. I've got some prepared remarks. I'm happy to answer your questions. And before I came to the Federal Reserve, I was a public school teacher. So I have a solid dose of humility, and if it's beyond my pay grade, I'm happy to say so. So there you go. I'm going to share my screen so I can put up a few slides. Let's see. And there we go. Looks like we're not.
Click.
Get people coming in, so I'm clicking back and forth. So, all right, Charles, can you see the slides? Is that what I'm showing? You can just give me a thumbs up. All right, perfect. I will say that tonight I am expressing my own views, my own understandings, not necessarily that of the Federal Reserve Bank of Atlanta or the Federal Reserve System. I joke that they put the disclaimer in the water at our place of work, but these are unprecedented times, and I want to make sure that you understand that these are not, nothing here to go to the markets with. How's that? Let's see. We're gonna.
If you hit F5 or start slideshow at the bottom, it'll help.
Yeah, there we go. All right, I'm trying to manage the incoming people and all that, so I think we're there. All right, so a little bit of background. The Federal Reserve is a three-part structure. That's the way it was founded back in 1913. Actually, there were two original parts, the Board of Governors and the regional reserve banks. The The Federal Open Market Committee was added during the Great Depression with the Banking Acts of 1933 and 1935. So that is a structure that has persisted till this day. It's a robust structure, and it's a very interesting hybrid of different parts of the federal government. So let's look at that. The system is led by the Board of Governors, people that you hear about in the news. Chair Powell and Lee L. Brainerd both co-hosted a Fed town hall today. 2 days ago, Chair Powell was in front of Congress and giving testimony to the House Banking Committee. These are appointed positions. They are appointed by the President and confirmed by the Senate for a 14-year term. That there's one term that expires every year, and there should be 7 of them. You can notice that there's only 5 current sitting governors. Turns out that the appointment process sometimes stirs some amount of political controversy. And so there are 2 people that have been nominated for positions on the board. They have not been confirmed by the U.S. Senate at this point. So we have 2 empty vacancies. In addition to that confirmation as a governor, the president nominates 3 people to go through an additional confirmation process for the 3 leadership positions. So the chairman, the vice chair, and the vice chair for supervision are all subject to an additional appointment. And those terms are 4 years and must be renewed at the time. You might recall that Chair Powell was nominated for the chair position after President Trump declined to re-nominate Janet Yellen after her first 4-year term. So the chairs are the people you hear about in the news. Alan Greenspan, Ben Bernanke, Janet Yellen, and now Chair Powell. The second and really most interesting parts of the system that was devised in 1913 for the Federal Reserve Act was this system of regional reserve banks. The act specified that there would be between 8 and 12 banks established, spread out across the country. And the following year, a committee comprised of cabinet secretaries set out on a journey around the country to identify the 8 to 12 cities. They chose 12 and then drew borders around them, respecting the lines of banking and the lines of customary commerce. So you notice that Atlanta has the Southeast, but being the participants tonight that are from Dallas know that Northern Louisiana looks a whole lot like East Texas, and therefore it is tied to the Dallas Fed and not to the Atlanta Fed. In a similar way, in Tennessee, Nashville is much more connected economically to Atlanta, and Memphis is much more connected to St. Louis. So you can see that those cities were incorporated into those respective districts. The small dots are Federal Reserve branches. The Atlanta Fed has the most branches in the system, including the oldest branch in New Orleans and the newest branch in Miami. Miami was created in 1975. New Orleans was in 1915. Our 3 other branches are in Jacksonville, Florida, Birmingham, Alabama, and Nashville, Tennessee. Then finally, the third part of the structure is the Federal Open Market Committee. The 12 regional reserve bank presidents and the 7 governors of the Federal Reserve System meet together, and those 19 participants make the decisions about monetary policy that guide the economic force charts of our country. Now, all 19 participants are active members, and they are all very much a part of the discussion, but the voting structure is actually a little more complex. There are only 12 voting members of the Federal Open Market Committee, the 7 governors, and 5 Federal Reserve Bank presidents. It's always the Federal Reserve Bank of New York, the president of that bank, because that bank is the center for open market operations, the policy piece, the mechanism through which the Open Market Committee carries out its direction. And then the other 4 spots rotate among the other 11 Federal Reserve Bank presidents. So most Reserve Bank presidents serve on a rotating basis. Every 3 years, one of those presidents is voting. So Raphael Bostic, our president here in Atlanta, will have was a voting member last year and will be again year after next. So with that, let's stay on that slide. Charles, I'm going to let you look at, if you don't mind watching the chat, or if somebody would like to unmute, if anybody has a question about the structure, find these things go a little bit better if we take questions as we go. I'm willing to go.
I'll let you know if I see anything in the chat.
All right, you guys are welcome to put questions in the chat, and Charles will let me know, or you're welcome just to unmute yourself and then let me know if you have a question. All right, then we'll go on to the 3 things that the Federal Reserve does. I really say, you know, it's one of those school teacher things. If you know 2 sets of 3, you're probably in pretty good shape for the test. The first is our 3-part structure, the Board of Governors, the regional reserve banks, and then the FOMC. The second list of 3 that you need to know is that we supervise and regulate banks, we provide financial services, and we conduct monetary policy. Supervision and regulation is one of those items that almost comes out in one breath for people that work at the Federal Reserve. It's actually 2 very independent functions. First of all, it's regulation is really the bedrock. So Congress passes the law. I'll go back a little ways and say that Congress passed the Truth in Lending Act back in 1968. And it was up to the Federal Reserve Board of Governors to write the rules that banks are obligated to follow in disclosing the terms of a loan so that consumers can compare those loans fairly and equitably. It's once that regulation was written, it's actually called Regulation Z, but once that regulation was written, the authority to enforce that regulation was actually delegated to the 12 regional Federal Reserve banks. So we have a whole company of examiners that go out and look for 3 major things when they're examining a bank. They look for institutions that are run safely and soundly. I have a friend who has been with the Credit and Risk Department for a while. One of her jobs is to go, before the pandemic, before we all went to a remote work posture, went out to make sure that that banks had all of the loan documents in the right spot and could produce one on demand. Charles was talking about his audit. I'm sure that's similar to the audit that he has earlier. He was speaking of earlier, but we make sure that they are being run in a safe and sound manner. The other side of this slide talks about fair and equitable treatment of consumers. The U.S. banking system has long had a history of not providing access to credit and banking services to all the members of the community. It wasn't too many years ago that women were not able to access banking systems, and even as recently as the 2008 financial crisis, we know that studies have shown that the most predatory types of loans were often marketed in low-income, particularly low-income communities of color. And so we still have a ways to go, and we are working actively to make sure that all consumers have fair and equal access to the banking system. The third one right there in the middle is, let me admit someone new to the meeting. The third one here in the middle is really one that has come out of the 2008 financial crisis, and we're clearly seeing it again now in the COVID-19 crisis. I'll lean back. Some of you are from Houston, and so no offense intended, but Houston has an economy that lives and breathes oil, and it's a perfect example for this. If banks in Houston made a really solid decision to make a loan to an energy company, that could be a very rational, on a microeconomic way of thinking. That loan could make perfect sense in a world where oil prices are at a certain level. Lots of those loans could be extended into the energy industry, but then when oil prices decline, that challenges the entire system, because all of those individual rational decisions can collectively destabilize the financial system. Imagine, if you will, that everyone lenders were making individual rational decisions about lending into a mortgage market in 2006 to 2008, and then house prices started to decline. All of those individually prudent decisions led to a destabilizing situation for the whole financial sector. So that's the goal of supervision and regulation. Well, there we go. The next thing that we do is we provide financial services. One of the nicknames for the Federal Reserve is the bank for banks. Right here in Atlanta, we actually have an important role in financial services. We house the retail payments office for the entire system. We still process about 1,500 checks a day by hand. Almost every check in the pardon me, that's written in the country is actually processed via computer through images, but we actually get all of the checks for the entire country eventually wind their way to Atlanta to be processed if they never get imaged. In addition, all Federal Reserve offices and many of our branches actually process cash. We have high-speed cash processing machines that can examine over 100,000 bills per hour. Literally millions and millions of dollars every day. We're really testing for two things. The first thing is that we want to make sure that the money that has been deposited from the banking system is genuine. We find a number of counterfeits. It's a tiny fraction of the overall bills far less than 1% that are counterfeit, but we do find counterfeits. We turn those bills over to the Secret Service because the Secret Service, since the Civil War, has been charged with safeguarding the nation's currency system. So if the bill is genuine, then it's tested to see whether it's fit to go back out into circulation. Not too worn, torn, dirty, gross, taped together, stamped with "Where's George," graffitied, with "Happy Birthday." Whatever the case may be, we want to make sure that the money that's in circulation is in good shape and also is able to detect the counterfeits with all of the security features in good shape. We also process, most importantly, electronic payments. So there are two systems that electronic payments go through, both called ACH, the Automated Clearinghouse in general. One is run by the Federal Reserve, and one is run by the Clearinghouse, a private corporation owned by banks. They process all of the direct deposits, all of the online payments where you put your routing number and the account number onto a website to make a payment. All of those are processed through this ACH network, and those two networks actually process about equal amounts, about 50-50, and literally trillions of dollars per year is moved across those electronic networks. In addition, we have a high-value wire system called FedWire, where we move money quickly, securely, and irrevocably, as a matter of fact, which is a critical point if you're making a large, high-value transaction, and you want to ensure that the money is moved from one to another. Think when you're closing on a house or making a large transaction in the markets, FedWire would be the place where your bank is moving that money from financial institution to financial institution. We also provide financial services for the U.S. Treasury. We pay the bills. We accept deposits on behalf of the Treasury. So when you pay your income taxes, it goes to the Treasury's account at the Federal Reserve. We also distribute the payments that the Treasury makes. So we are their checking account. But just like your bank, we don't tell the country how to spend its money or how much to collect. So I say that my son doesn't get a call from his bank wondering if he should go to work more. He's my college-age son, so he neither gets advice on how many hours a week to work, nor whether or not he should buy new golf clubs. So we don't provide advice to the U.S. government on how to spend money. We just process it for them. Finally, probably the most famous thing that we do is monetary policy. So got the standard boilerplate definition here: the actions of a central bank that influence the availability and cost of money and credit to achieve the national economic goals. So there's three really key portions of this definition that you have to consider. The first one is that it's a central bank. This is a power that's being uniquely vested in the Federal Reserve by the Congress. No other bank or institution has this power. When I say influence the availability and cost of money and credit, we're getting a little more technical, but as money and credit is more available, it's just like any other commodity. If it's more available, typically the cost comes down. The cost of money and credit is interest. If the Federal Reserve takes actions to make money and credit more scarce, then that makes it less available, and therefore the cost rises and interest rates across the economy rise. Why do we do those seemingly pernicious things? They are to achieve the national economic goals, and those are stable prices and maximum employment. Those goals are congressionally mandated. They were enshrined in the Federal Reserve Act through amendments and through the Humphrey-Hawkins legislation in 1977 and 1978. So we don't choose those goals. Those goals are given to us by Congress, and we are obligated to pursue monetary policy that strengthens the achievement of those goals. So when does that decision get made? Well, the decision, traditionally, the decision about monetary policy happens at regularly scheduled meetings of the Federal Open Market Committee. And they're going to evaluate a large variety of information. We are a hiring program for PhD economists that are studying economic indicators, that are modeling how those can be used to assess the direction of the economy and the overall health of the economy. But we also rely on a tremendous amount of information that we gather from our constituents in the regions where the Federal Reserve banks are located. So that process actually results in something called the Beige Book. It's released about 3 weeks before the Federal Open Market Committee meets. Publicly available document, but it summarizes the anecdotal information about the economy. And of course, particularly in a time like this, where economic conditions are changing so rapidly, that the movement in the economy is outstripping the ability of the Bureau of Labor Statistics and the Bureau of Economic Analysis to even measure these items. This anecdotal information is critical for our understanding of the economic conditions that we're responding to. How do you know what happened? Well, immediately following every Federal Open Market Committee meeting, both the scheduled and the unscheduled, there's a press release. And that press release typically has 4 consistent portions. It states the target for the federal funds rate. It summarizes the economic conditions. It talks about the balance of risk, whether or not the risks to the economy are weighted toward inflation, so-called upside risks, or the risks are weighted toward the downside or recession. And then finally, the statement always closes with forward guidance, looking forward to what would change the committee's posture, what would change their minds, what data they will take into account going forward. And it's always related to that congressional mandate of maintaining full employment and stable prices. I think this is an important time to stop and talk about monetary policy versus fiscal policy. Those lines are easily blurred. Monetary policy is all about the availability and cost of money and credit. It's actions that we've taken to ensure that the circulatory system of the economy is running well, that money and credit is available, and markets are liquid. Fiscal policy, on the other hand, is all about the taxing and spending decision. And like I said, we don't We don't dictate to Congress and the president how to spend the money. That is the other end of Pennsylvania Avenue. So with that, why don't I, before I kind of launch into a little bit more current stuff, I thought I would take a minute and let you ask questions about the functions of the Federal Reserve.
All right, so I have a few questions here. This is Charles, that were sent to me.
Great.
First question, when is the next Fed meeting?
That is a great question. And
you said it was 8 times a year?
There are 8 regularly scheduled meetings a year, but there can always be additional meetings as required. So back in March, there were several unscheduled meetings. There were 3 unscheduled meetings, March 3rd, March 15th. The March 17, 18 meeting was canceled, and the March 19th and 23rd and March 31 were all unscheduled. There was an FOMC meeting on April 28 and 29, and then the next one will be on June 9th and 10th. So,
okay,
Federal
June 9th and 10th. How often are new metrics added to reviewing the economy?
So I would say that there's always a possibility of an economist looking for a new way to model. So, for instance, I had a good friend at the. We'll take the example of inflation. So inflation is measured using a price index. Really, since Alan Greenspan, the Fed's preferred method of calculating the inflation and measuring inflation in the economy is through the index called the Personal Consumption Expenditures Price Index. It's a broader basket than the Consumer Price Index that you've probably heard of. Well, we've got the broad Personal Consumption Expenditures Index, but then we also have so-called core PCE, where food and energy is stripped out. Turns out that often the price of food and energy are some of the more volatile items in the market basket, and they can tend to skew the data. And so that's a new way that economists would examine that inflation. But I had a friend in Dallas named Jim Dolmas who actually looked at the PCE and created a trimmed mean PCE. So it was a new innovation in examining that same data that had been around for years. And someone's got a really cute little girl that just popped in. Marcus says she's precious.
Go ahead and mute everybody.
It's always fun to see kids that join. So Jim came up with this idea of, rather than just always including food and energy, it was like the figure skating analogy where you would throw out the top score and the bottom score in the Olympics, right? He would throw out the most volatile prices and the least volatile prices in each period. So it was a way to more finely tune that same data. So new information, there's national income accounts that form the core, but we're always looking for new ways to examine that data and suss out the truths and the implications of that data.
Right.
Great. 1 second. Yo, AJ, mute your microphone.
Okay. Princeton, you may want to just mute everyone.
I will try to do that. Let's see. There we go. We'll just go with it. I'm not seeing it while I've got the slideshow up, so I think it's going fine. So,
okay.
What was your question, Charles?
Another question. How much money is actually counterfeit that runs through the Fed?
So it's on the order of hundreds, several hundred bills per day in Atlanta. I mean, several hundred bills per week. I misspoke. And we process about 500,000 bills per hour, 20 hours a day. So 4 days a week. So our cash folks work Monday through Thursday in 2 10-hour shifts. So we are processing hundreds and hundreds of thousands of bills, and less than 1 to 200 are counterfeit. So it's a tiny fraction.
Okay. Also,
Most counterfeits actually come in kind of bulk. But the I-95 corridor is sort of a hotbed for counterfeit. Counterfeiters will go town to town up I-95, passing counterfeits, getting change, then returning merchandise. So we do see a non-insignificant part of counterfeiting.
okay. Last question before we continue the presentation. What is the relationship between the Fed, Federal Reserve Bank, and the Treasury with regard to all the debt that the Treasury issues to pay for everything?
Sure. So obviously, whenever the federal government, and Charles, don't let me forget, someone named Leon's iPad raised their hand, and so we'll call on them after I make this answer.
I think that's related to this. Yeah.
Put it in the chat. You're welcome to. So that is a great question. There's several layers to that question. First of all, remember that the decisions about spending and taxing are made by Congress and the president. So by implication, if you know how much you spend and you know how much you bring in revenue, Congress and the president are also deciding how much to borrow on behalf of the country, right? That is their power, and that's granted to them in the Constitution. On the other hand, as their bank, the Federal Reserve actually facilitates the sale of those Treasury bonds into the open market, so that individual investors, retirement funds, global markets, foreign governments, foreign investors, anyone can buy those Treasury securities in their initial offerings. The Fed does not buy Treasury securities in that initial market. On the other hand, the secondary market for U.S. Treasury securities is one of the largest and the deepest markets in the entire world. It's a very liquid market. And so to carry out our open market operations over the years, U.S. Treasury securities have been a preferred investment for the Federal Reserve, because when we buy those securities in the secondary market, so let's say Charles has $1 million worth of Treasury securities that he wants to liquidate, and the Fed buys those from him in an open auction through one of our primary dealers, then Charles ends up with $1 million in his bank account. His bank is newly enabled to make loans and extend credit because of those new deposits. And the Federal Reserve increases its holdings of U.S. Treasury securities. We do not buy those Treasury securities directly from the Treasury. That would be a bright red line, because that enables us that would be directly monetizing the debt. But we do buy those Treasury securities that have been purchased by individual investors. Does that answer the question? If someone...
Yeah, let's keep going.
All right.
I had a question.
Sure.
My question is how are we going to be able to handle these huge deficits we're running? I mean, it's got to be close to 500 billion, I'm guessing, and just to pay the interest on the debt we're accumulating, how are we going to be able to handle this huge deficit? And I understand we're going to run another $4 trillion this year. How do we make that work?
Well, so that is the purview of our elected representatives. You really see a balancing act, and you saw it in Chair Powell's testimony before the House Banking Committee this week. It's a balancing act. We have deep harm that has befallen the economy because of the precautions that had to be taken to safeguard public health. It's certainly good policy to safeguard the harm and to prevent further devastation to the U.S. economy. On the other hand, before this, we had and it's Democrats and Republicans. We'll insert the disclaimer again right here that I am speaking on my own. But we've had policymakers that say that, unfortunately, we seem to Americans like tax cuts, and they also like government spending. And rarely do we vote for, as citizens, people who are willing to both raise taxes and spend less. And we all know on a personal level, that's what it takes to get out of debt, is to spend less and to raise more revenue. And those are difficult policy prescriptions for an elected representative to swallow. But at the end of the day, that is. But President Bostic and Chair Powell have both said that this is not the time, in a period of great economic turmoil, to try to pay down the debt. We have to get the economy healthy again before we can begin to think about that again. I know that's not a real answer, Leon, but that's the best I've got.
Thank you.
All right. I think the Chair Powell and President Bostic have both emphasized the fact that that this pandemic is particularly challenging because we entered this period of a public health crisis with a fundamentally healthy economy. It was growing. Unemployment was at historically low levels. Inflation was running even slightly below the target. The economy was really in outstanding shape when this pandemic hit, and the decline has been significant. Untold millions of people who have filed for first-time unemployment, businesses that have a tremendous amount of uncertainty, financial markets that have seized up because of the uncertainty of investors. Just uncertainty has reigned through this period. And both Bostic and Powell have talked about Fed actions as being a bridge. If we can get from a fundamentally healthy economy over here to a fundamentally healthy economy post-pandemic, then if the policy actions can bridge that gap, then we will be much better off and the recovery will be stronger. Of course, the longer that period of uncertainty remains, the more difficult that recovery can become. We just really don't know at this point how soon the economy will begin to recover. Much of that has to do with consumer confidence. So individuals have to become more confident about spending money. People have to be called back to jobs. The economy has to stabilize again before we can really anticipate what the economic recovery is going to be. This is an interesting chart. At least it's an interesting chart to a data nerd like me. You see GDP declined. We don't have second quarter numbers yet, but in the first quarter it declined 4.8%. What's interesting is what was contributing to the decline. So many things were contributing to the decline. Things like consumer spending, all the things you would expect: consumer spending, non-residential structures, and all these things below the line. We were buying less from overseas. That's that red bar that's on top. So as our net exports actually contributed positively because we were cutting back. We were importing many fewer things from overseas. So that lack of imports caused our trade balance to move in a positive direction. But overall, just unprecedented harm to the U.S. economy. I mean, and all of these charts, it's almost like it's hard to imagine the overstatement of how disruptive this has been. You know, they're saying that there's severe disruption to the sales activity. Sales levels are far below. We're just now getting updated numbers, and we're just continuing to see harm to the economy. The best thing that we can say is that with the unemployment claims numbers that came out this week, the number is beginning to decline, but it's still 10 times what it was before the crisis. So the numbers are still at a historically high level, even though they are getting less bad each week. Let's see. So this is a mark of the labor market. You know, this is with this far right-hand side of the chart over here. You see that vertical red line. That's not a border. That's what happened to the unemployment rate, and it's just unprecedented. This will be a point in the economy that will resonate for years to come. Every chart, every scale has been blown out of the water by this crisis. You know, the fact that that the monthly change has gone, and these numbers will continue to decline more with each passing month. Hopefully, we can see that they're getting, like I said, getting not quite as bad. Not the decline is not quite as steep. But it's still, we are still in very rough shape. On the other side of our mandate, if our mandate is maximum employment, we are far from achieving that. Stable prices. The Fed has an explicit price goal of a 2% inflation rate. So we want to see prices rising at a steady 2% every year, so that people can plan and know what to expect. Those inflation expectations are running far below our target rate, and so we would hope to see that and that is in the presence of all of the unprecedented liquidity that the Federal Reserve has pushed into the system. Businesses are still expecting overall a decline in the rate of inflation. Like I said, labor markets were strong and consumers were confident beforehand. We hope that we can bridge to this other side so that those strong fundamentals will take over again. Of course, the longer that people are out of work, the longer businesses are forced to remain closed to safeguard the health and safety of the population. The longer it takes for consumer confidence to return, the more difficult that recovery will be. Really, essentially saying the same thing, that you know, there were strong fundamentals, and we hope that we can return to those. I'm seeing a couple of hands. Charles, why don't I take a couple of, I'm guessing that there might be a couple of questions, and then before I get all the way to the end.
Sure, go ahead. I think I'm seeing on the chat, you know, one of the big questions, I see it on the chat, and this is a question that a lot of people are asking right now, is
Sure.
with all the bad news coming out, especially every day that unemployment reaches a new high, the stock market keeps going up. Can you shed a little bit of light on the Fed's view of that, of why the economy keeps getting worse, but the stock market keeps going up?
I don't know that I have a Fed's view of that. I mean, I'd go back. You're the investment advisor, so you're in a position to answer this than the outreach manager at the Fed. But I suspect that it reflects at least some fundamental economic confidence of what I'm saying, that there was a strong economy beforehand that must have in some way justified the growth in the stock market, that we were reaching historic highs, and some level of confidence that we will return to those those days if we can get to the other side of the pandemic, right? This is not necessarily, this was not a financial crisis like 2008. There was not, the banking system has been responsive and it's actually trying to help. So there's strength in the banking system. Perhaps the stock market is reflecting that underlying confidence that once we get to the other side of the health crisis, that we can return to a more sure footing and solid economic growth. That might be an answer with no answer, but that's where I leave it.
That's fine. That's fine. I have some opinions, but I'll share them, separately. Go ahead and take, if you want, a few questions.
Did anyone else have a question? You're welcome to unmute yourself and ask.
I just texted a question, actually. My question has to do with, I don't know if this is your area or not, but I've been hearing a lot about negative interest rates. And how does that help, or what does that do to the economy and to specifically like money market funds, treasury-backed and non-treasury-backed money market funds?
Sure. So negative interest rates have been pursued by other central banks around the world. The Federal Reserve has not pursued negative interest rates, and I don't expect us to communicate anything using negative interest rates currently. Negative interest rates are simply a way to disincentivize savings, right? So, but we have actually created liquidity in the economy through our open market operations, through various liquidity facilities that we've pushed out. I don't expect the Federal Reserve to toy with in fact, it's been explicitly denied by the policymakers that say that they don't prefer to discuss negative interest rates. In some ways, however, negative interest rates and quantitative easing are in some ways the same thing. We are pushing more and more liquidity into the system. We're just simply not communicating that as a negative interest rate. That seems like something that the policymakers to this point have been unwilling to, a bridge that they have been unwilling to cross. So I don't expect a negative interest rate announcement from the Federal Reserve. My invitations to the Federal Open Market Committees have never been, but that is I don't expect that to happen. I'm seeing a couple of interesting questions here. Does Atlanta process the stimulus checks? So yes, the Federal Reserve System, but we don't print those Treasury checks in the Atlanta bank. But I think those come out of maybe Kansas City. But yeah, the Federal Reserve System does, but not necessarily the Atlanta Fed. Cindy said, with so many people sitting around the table, how can the Fed reach any decision? And I would say that the 19 participants on the Open Market Committee, there's been pre-work and there's been some discussions before their two-day meetings. But I also think that the Fed is largely a consensus-driven body. So they are looking for consensus. One of the more interesting things to look on FOMC statements is when there is dissent. Those dissents are recorded, and those dissents are actually stated with cause. So you can tell if someone is dissenting because they'll record that vote, and they will record why they were why they dissented. So we got the negative interest rate. How will the growth of Bitcoin affect the Fed? Bitcoin is outside of the Fed's jurisdiction. it is, as a cryptocurrency, and it's extranational. So it was, so it's outside of our control. It's a tiny fraction of the U.S. economy, an infinitesimal fraction of the U.S. economy. We're studying it, we're watching it, but it doesn't concern us at this point. In fact, some of the Bitcoin technology with the blockchain is actually being actively studied by our payments people, because it's a very secure way to continue to safeguard electronic transactions. Byrne asked, were the credit markets about to freeze before the liquidity was put into the markets? Yes, they were. If you read President Chair Powell's testimony from 2 days ago, he talks about various markets seizing up. Many of those actions that we took in the credit markets, more specifically in targeted actions, come under something called Section 13.3 authority. It is the authority to step into markets more aggressively and under unusual, the text of the law says unusual and exigent circumstances. That has to be approved by the President, by the Treasury Department, by the Secretary of the Treasury. And so we have entered those markets with the full support of the Treasury and in concert with the elected officials. So that's an important distinction, but it was very severe. AJ Wind asked, what does the Fed's balance sheet look like right now? It's enormous and growing. So before the crisis, it was sitting at about $4.5 trillion. It's well over 8 right now, but I don't remember how much it is. The size of the balance sheet is released every Tuesday. It's released on the Board of Governors website at federalreserve.gov. If the health crisis continues for another year, maybe a second wave, do you see a crisis with financial institutions? That I would say that the Fed stands ready to safeguard the banking system. During the 2008 financial crisis, we saw an unprecedented financial crisis in the United States, and the Fed stepped in aggressively to safeguard the banking system. On the other hand, this is a time when banks are fundamentally healthy, but we have taken a number of steps to safeguard them and to shore up their liquidity so that they don't fail and that we don't have a financial crisis on top of the health crisis. Mitchell asked, why does it seem like consumer rates come from oh, no, wait. Why does it seem, sorry, it moved on me and then I lost my train of thought. Why does it seem like consumer rates, specifically credit cards and mortgage rates, fall last and less than other rates? Mainly because those there are a number of other factors that actually determine a credit card or a mortgage rate. So creditworthiness of the borrower, the length of term, the type of security, all of those are going to affect the interest rates on those consumer-facing products. And so there are so many other factors that the portion that can be controlled with monetary policy is smaller, although it's not insignificant. I'm racing through some of these questions, but then I'm happy to go back and ask more. Where does the money come from to expand the balance sheet? Said differently, does the Fed have the unlimited ability to produce money and liquidity? And the short answer is yes. We do, in fact, have the unlimited ability. That is the power that has been granted to the Federal Reserve, like central banks in other countries. In essence, it's a politically charged thing to say, but we can, in fact, print money. We don't actually run the physical printing presses. We actually we actually create money through electronic transactions and electronic credits to bank balance sheets. But we do we do print money, and we have that unique ability. In a fiat money system like we have, that ability is crucial to our ability to manage and, frankly, to respond to crises such as this one. What are the mechanics of what is done with bills that are deemed too damaged to circulate? They're shredded. We shred many tons of unfit currency every day. In Atlanta, we actually use that we sell that shredded currency, and it's used as biofuel at a manufacturing plant. We package up a little bit of it to give away and as souvenirs in our museum when we're open. But the vast majority is here is sold for biofuel. Other Federal Reserves in their local markets, some people are able to compost it. It is all reused.
Yeah, but what I was asking is, do you then in turn tell the mint, we shredded $1 million worth of currency today, we need $1 million printed to replace it?
That's a great question. We actually, when we produce an annual currency order, so the mint produces coins, and the Bureau of Engraving and Printing, with facilities in Fort Worth, Texas, and Washington, D.C., and we produce a annual currency order, so that tells them how much we are their largest and practically only. They have a few other contracts to print things for the president and other executive offices, but basically that the full-time job of those two factories is to print money so that we can put it back into circulation. And it's all done on statistical modeling and demand forecasting. So it's not a one-to-one, we shred a $100 bill so we get another $100 bill. We forecast how many $100 bills we need, and then we remove them from circulation as needed. Couple of things that are combined. How concerned are you about inflation? And is the Fed part of the New World Order? So on the inflation front, I would tell you that confidence in the Fed's ability to control inflation has been a lasting gift from Paul Volcker. And so that everyone believes that we can control it, and we have taken strong action to engender that confidence. That is really why the Fed's actions work, is that people believe that we will be steadfast in our resolve to control inflation, even if that means some temporary economic pain like it did in the late 70s and early 80s. Some of you on this call will remember mortgage rates that look more like a high-risk credit card rate. I do find it interesting that lots of people have a lot of suspicion about the Fed. I think it comes from a fundamental misunderstanding of what we do. We were created by Congress for a very specific job, and I find that people, when they hear about what the Fed does, and I talk rationally with them about what we do, they tend to appreciate it and leave with more confidence. I hope I've done that tonight and answered your questions. That's certainly my intent. That's my whole job, is to help people understand what the Fed is and what we do. So, those are, that's what we do. Those are the questions I have. Let me see. I'm going to close my chat so I can see what I'm talking about. We are really about liquidity in the banking. I think we've talked about many of these. We've talked about these. We've talked about all of those. Stabilizing financial markets. We're using all of our tools. Sometimes I get ahead of myself and I talk about questions, and then I answer the information that's on the slides ahead. And this is just talking about the fact that we've done a tremendous number of things. really through three primary channels. And as you're watching for Fed in the news, there are three primary channels that you're going to look at the Fed acting in the economy. Through the decisions of the Federal Open Market Committee, reducing interest rates, authorizing further open market purchases. The Board of Governors is actually allowed to and empowered to change the regulatory burden on banks and other financial institutions. So they are doing that to ensure a smooth smooth transition over this crisis. And then, as I mentioned, Section 13.3, those are the emergency lending powers that are granted to the Federal Reserve with the approval of the Secretary of the Treasury. So these next two slides have way too many words on them, but you can see that early on, the FOMC there in green was taking major steps, and then quickly the Section 13.3 authorities ramped up, and we began to pull out things like the primary market corporate credit, the term asset lending facilities, the municipal liquidity facility where we're buying bonds from state and local governments, the Paycheck Protection Program, the Main Street Lending Program. All of these are through those 13.3 authorities that the Treasury Secretary has authorized. So we're here. I closed my chat. Charles, did you see any more questions that came through?
I think that was it. Yeah, I think you answered all the chat questions. Other than
I'm going to call you out, Stan. I did get one.
Okay.
I have read Creature from Jekyll Island, and I was a good. The Jekyll Island story is a great one. The Fed was not created at Jekyll Island, but I've heard it's a great resort. Now that I've been in Georgia almost 2 years now, and I still haven't made it to Jekyll Island, so I'm looking forward to going there. But I've also been gifted when I was doing a large part of my work in Dallas and here in Georgia is outreach to teachers, helping them teach economics and personal finance better. And I've had 2 copies of Ron Paul's In the Fed book gifted to me over the years. So I have those on my shelf at my desk. So I've read the naysayers. That's what you have to do if you're going to be talking about all of this. And I still believe in the institution that I work for. So there's lots of people that are really working hard to make sure that this economy works well for the benefit of all Americans. So Charles, with that, I'll turn it over to you to close out the meeting.
Yeah, wonderful. Okay, well, thank you everyone for joining us. Hopefully this was informative and educational. I'm glad we got, to hear about what the Fed does behind the scenes and where their powers come from. If you do have any follow-up questions about the economy, send them to me. I'll forward them to Princeton. If you have questions about the stock market, about why it's so high, about strategies of what the expectations are in the future, I know a lot of people are scratching their heads about why it's so high right now compared to, what we're seeing in the economy going on. I've got a few answers, theories about that. I do a lot of reading. As a financial advisor, I read about what the Fed's doing in the economy, but also I'm kind of the link to what are the strategies and why is the market the way it is. So feel free to send me some questions and I'll be happy to get back with you and discuss it with you. But Princeton, thank you so much. This was wonderful. And
thank you very much, Charles. I appreciate the invitation. And it was a real pleasure to talk to all of you guys tonight.